Intel Corporation, ticker symbol INTC, is currently trading at $20 a share. It has been absolutely hammered this year, down almost 57%. What we're going to be doing is looking at the company's stock price, then taking it to my automated stock valuation spreadsheet to see if Intel is a buy with this dip using this discounted free cash flow model, the comparable company model, the dividend discount model, and of course the Ben Graham formula for intrinsic value. As I said, Intel has been hammering its head, has some recent bad news. It's paused its dividend, which a lot of investors have not liked. And basically this stock has been trading, if we look over the last sort of all time, it is back down to 2010 levels, which is absolutely crazy. But is this the right time to pull the trigger and buy? Let's have a look at my automated stock valuation spreadsheet. If we just put the ticker in INTC, this will load up all of Intel's latest financial data. As we can see here, market cap of 87 billion, a very high P ratio, which is not a good sign. The market is currently around about 29. Intel is 92, earnings per share of 22 cents, a beta of 0.05, which is quite surprising actually, due to the fact that it has had a 50% decrease. Analysts are saying it is a buy with 26%, and they were previously paying a 2.5% dividend yield, which is currently being paused. So let's have a look at the company's revenue. Revenue is down in the trailing 12 months. It had its all-time high back in 2021 of 78 billion and is now on the negative slope, which is bad to see. Next, we're going to look at profit. Are they profitable? Yes, just about 1 billion in the profit in the trailing 12 months, down from sort of consistently 20 billion and then down to 8 and 1.69. Free cash flow, I imagine this is a similar story. Actually, no, it is worse than that. They are negative free cash flow, 12 billion in the red. Now, Intel have been doing a lot of spending, ramping up for this sort of AI revolution, but currently, yes, they are negative in free cash flow. Were they buying back shares previously? Yes, again they were, and then as of 2020 they have been issuing new shares which can raise capital, and to be fair, in their defense, it did work out pretty well because the share price back in 2017 to 2020 was at recent highs, not all-time highs but recent highs. So with the stock price dropping, that actually has turned out to be quite a good idea. Now if they keep on issuing shares at $20 a share, that is not good. Assets versus liabilities. Liabilities are high, assets are low. Once again, not a good sign. So overall, not looking very good. We'll look at my trailing 12-month discounted free cash flow model to see what that values the stock out. What this is a way of evaluating a stock, looking at future free cash flows, discounted days value. So overall, it's calculating minus 16%, $16 a share. That is because these numbers are in the negative. Basically, revenue has slowed, so let's see what analysts are saying on future revenue growth, and we'll put that in the sheet. Where is the revenue here? We'll go on the average, 47 and 50 billion. They are still expecting growth, although I suppose this is, they're not actually expecting growth. Let's drop that down. They're expecting growth over those years, but not decreasing. So let's just bring this up to about minus 5%. That's still negative because of the free cash flow. Net income margins all over the place again. Let's just keep it as it is. And free cash flow. So previously, Intel were around about 70%. This would actually put them at around about a $27 stock, which would indicate a buy. But obviously, free cash flow has been negative in this year, so quite difficult. Let's just have a quick look at the other valuation. Yeah, I think this is on the too high side again. We'll bring that down to this number of about 70%. $24 a share again. So discounted free cash flow does like the stock. It does think it is a buy, but overall, not the greatest of signs. Next, we're looking at the comparable company model. This is a way of valuing companies looking at metrics of a similar size. We look at price to sales, price to book, PEG, EV to revenue, EV to EBITDA, earnings before interest, taxes, depreciation, amortization, and finally the PE ratio. So we'll go with sort of on the high side initially. We'll go on the bull case, I suppose, if they are the same as Nvidia, AMD, and Qualcomm. What this will do, this sheet will load up all the company's financial data so we can compare. Please check out my Patreon if you're interested in downloading the sheet. So if we were to evaluate these companies' sort of metrics, you can see it is a massive buy actually at $64 a share. This looks at revenue. If we look at the revenue, you can see it's actually towards the upper side, 55 billion compared to Nvidia's 80, ahead of QCOM and AMD. Growth rate is in the negatives, which is obviously bad. Net income not profitable, no margins compared to these other ones. Nvidia 50%, that's absolutely massive. QCOM as well, I'll probably do a video on them, 23%. Price to sales, price to book, we want these lower than one, so these would indicate it is undervalued, usually under this. And then the PEG ratio, which is price to earnings growth, surprisingly the highest. 1 is fairly valued, anything over that is over, and under is obviously under, and it is the highest out of Nvidia, Qualcomm, and that. If we look at the EV to revenue numbers, EV to EBITDA and PE, it actually is the highest PE, and on the lower side of those. AMD, sorry, hasn't actually loaded, but what I wanted to do compare is something a bit more similar. If we look at IBM, and what was the other company I wanted to look at? AMD, I suppose, are in the mix as well. We will also see IBM, Intel. Yeah, if we take Nvidia out and sort of compare, just let me switch these around. AMD, QCOM, and we'll just compare sort of to IBM more comparisonly, or compare to them more directly. Sorry, comparisonly isn't a word. You can see it is about undervalued as well. Okay, there you go. Nvidia, AMD has loaded now on a second attempt. They don't have a PE ratio at the minute for whatever reason. Once again, that's still putting it at about a buy. PE is obviously erroring, but you can see that's around about $50 a share. Dividend discount medal, we'll skip straight by this. They're cutting the dividend, or pausing the dividend actually. So previously this will not calculate. Once again, minus prices given here. And finally, the Ben Graham formula for intrinsic value. I'll just quickly go through this. Low earnings per share, and I don't think they're growing at 20%. And with this high bond yield environment, it probably doesn't make sense in Ben Graham's eyes to... they're actually expecting quite high growth, 26%. Analysts are pretty bullish, as they are on every single stock. 26% still puts the fair value at around $7 a share. With a AAA bond yield so high at the minute, it doesn't suggest it is the right time to buy. So just to summarize, discounted free cash flow model actually surprisingly likes the stock, but thinks it can grow in around about 30% increase. Comparables company model all over the place. If they can get valuations like Nvidia and AMD, then yes, it is a buy, but that seems unlikely. No dividend, and Ben Graham says it's a sell as well. Right guys, thanks for watching the video. Please check out my Patreon if you're interested in downloading my automated stock valuation spreadsheet. Subscribe if you're not already, and like the video, and I will catch you guys next time.